All right. Well, welcome everybody. Good afternoon and welcome to Charger Chats. I'm Michelle Farmer, the Assistant Director in the Alumni Office. We're glad that you joined us this afternoon. Today's chat is with UH alumnus John Gibson, a financial analyst at Hightower Twickenham. And John has been with Hightower going on 7 years this fall, and he'll be sharing helpful tips and useful advice on financial planning in crisis. Specifically, he'll be covering what's happening in the markets and what to expect moving forward, as well as how we can respond to the market crisis today. And just to let you know, we'll let John speak first, and then we'll allow time at the end for Q&A. And if you do have a question, you can use the chat function of Zoom and drop your questions in there, and we'll get to as many as we can at the end of the presentation. All right, thanks again, John, for joining us. I'm going to hand it over to you if you want to share your screen and start your presentation.
Yeah, thank you, Michelle, and thank you everybody for your time. And it's fun for me to get to do this. So yeah, I'm just going to start. I've got some slides to share, but I'm going to start with just some observations that we have that I have for what's gone on in the past few months. A little bit about what we expect going forward, and then end with some some just investing basics, but also how to think about investing during times of crisis, maybe how to be proactive, how to be reactive. So yeah, let me share my screen here. Let's see. So yeah, I've titled this "Markets During Unprecedented Times," and I think I saw this quote from actually Vladimir Lenin, not necessarily share his political views, but he said there's decades where nothing happens and there are weeks where decades happen. And I think we can all agree it seems like these last 6-8 weeks that decades have certainly happened. So I titled this "Market During Unprecedented Times." So a lot of what we've seen is unprecedented, at least in our lifetime, as far as what we've seen with the coronavirus and the economic lockdowns. Yeah, so, and you also have my contact information there. Feel free to email or call me. I'm not too hard to find online on LinkedIn or on our company website too. And I think we're sending these slides out to everybody too, so you'll have my contact information there. So yeah, let's dive right in. I've got here a chart of the S&P 500. It's in red since 2005. And you can see how it traded throughout the years. That gray area in the, towards the beginning is the financial crisis. So that gray, it's shading that recession there. The blue line going across measures is the VIX, or it measures the volatility, and it tends to spike particularly when markets drop sharply. So you can see how it spiked in 2009. And then in this recent crisis, how it spikes just as high, a little bit higher than what we saw in the financial crisis. Now, in the financial crisis, the S&P 500 dropped from peak to trough 50.95%, so was cut in half. This more recent downturn so far has only dropped just over 35%. So not as big of a percentage-wise drop, but because it happened so fast, we saw volatility spike just as high. So in the financial crisis, of course, we lose we lose our homes and our banks, and the whole system goes under here. We lose sports, we run out of toilet paper. All kidding aside, yeah, a very bad disease. We have to shut down the whole economy. So since then, you can see, and it might be a little hard to see, but we've recovered a little over 50% of those losses so far. A very, very quick recovery. The financial crisis took the market, close to 5 years for the price to recover, fully recover. If you include dividends, of around 3 years. But here we've already retraced about 50% of those losses. I think we had the fastest 30% decline ever, and we've had a very fast, halfway recovery so far. And that I'll get into a little bit of, some thoughts about that because we're still getting a lot of bad news coming out. And but in general, markets tend to decline or tend to recover before we get really good news. And you can see in this financial crisis, the market's already recovering before the end of that recession. Jeremy Grantham, he said, the market doesn't turn when it sees light at the end of the tunnel. It turns when all still looks black, but just a subtle shade less black than the day before. So of course, we're in a recession now, a GDP recession. Most economists think, that for the year, we're going to end up the GDP down around 7%. You can see this chart on the left, ING Bank's prediction for the year. Chart on the right just shows what we've got so far for the first quarter, GDP down 4.8%, how that breaks down. Everything about recessions are very hard to predict. The timing, the location, duration, magnitude, policy response. So very hard to predict, but this is what we have so far. We have a little bit more data than we did several weeks ago. Of course, S&P 500 earnings are down. First quarter so far, I think we've had most companies report down close to 14% on this top chart. You can see the S&P 500 companies that have more of their revenues international or more of the revenues outside the country, so more international companies, their earnings are only down 1.3%. Sales, the bottom chart, sales are actually up for the S&P. So up about 0.7%. Again, the companies, multinational companies faring a little bit better. Now here we have earnings, throughout the year. So each bar represents a year from 1988. You can see how the market's earnings have increased over time. And of course, we've had some periods where they've been down. So up and down, but generally up. The three bars on the right are, the analyst estimates going forward. So we have 2020, of course, is down from last year. We're going to have, second quarter earnings are probably going to be worse than first. But then, most people are projecting, going forward from that, earnings back on track. And I like this chart too, because, in the last bull market, a lot of people said, well, the market's only going up because, the Fed's printing money, quantitative easing. But you see the markets are actually more earnings driven, more correlated with how much the companies are earning. And I think part of the reason why we're already seeing a rebound, and markets could retrace back. We don't think they're going to retest the lows. They could, though, however. But I think we're getting that recovery now because about 90%, and this is from Jeremy Siegel of Wharton, he estimated about 90% of the value of the S&P or stocks is based on earnings a year or more out. So a lot of the valuations that are put on the market are based on what we expect going forward. Something else on that, equities or stocks are basically the longest lived asset. You have bonds have maturity dates. Equities are, perpetual in nature, or, ideally. And so being such a long lived asset, they're a lot more forward looking. In fact, the S&P 500 is actually considered a leading economic indicator. So devastating gauntlet so far for equity markets. Of course, the COVID-19 pandemic, the whole economy shuts down, OPEC blows up, worst GDP print since the Great Depression, record unemployment rates, oil somehow goes negative for a couple days, and then big earnings miss. Our pets' heads are falling off from Dumb and Dumber. It's just almost everything is going bad. And so, while a lot of investors expect a retest of the March lows, I mean, like I said, this could happen, but I mean, if we're not going to get another gauntlet of headwinds that are worse than what we've seen in these past, 8 weeks, we think it's a lot less likely to retest the lows. So another point on that, since 1929, we've had 10 market pullbacks of 30% or more. every time the market has recovered, has retraced 50% of those losses, it never retested lows. So if we take history as precedent, we should have a continued recovery from here. I definitely think there's going to be more volatility, but we at this point don't think that that the market goes all the way back down. We just don't see anything that's worse than this gauntlet for equities happening in the near term. Now, of course, just like the Spanish flu, we could get a new wave of coronavirus. Still, probably not the same response as far as locking the whole economy down. And then, of course, we could get vaccines or better treatments. But as things start to open up, I think the market's going to be a lot more forward-looking. Now, just to look back at, the last two bear markets and where they bottomed and started to recover. I said before that markets tend to recover before the end of a recession. So let's look at the last couple recessions. The two charts on the left are going to be from the dot-com bubble crash. And so if you look on the bottom left, the market bottomed on March 11th, 2003. But we didn't get peak jobless claims until April 18th. And then we didn't get our worst unemployment rate until July 4th. So the market was already recovering before the worst news came out, and certainly before good news started coming out. Again, if you look on the two charts on the right, at the bottom right, the S&P bottomed on March 9th, 2009. Actually hit $666. So I hope you're not superstitious, but it starts to recover from March 9th. We don't get peak jobless claims until March 27th. And then the worst unemployment rate didn't come out until November. So markets rebounding well before, even the worst news comes out. So if we look back at, all the recessions since 1953, or, just taking more modern data, markets have recovered on average 4 months, they bottomed 4 months before the end of the recession. So on average, markets recovered 25%. They rose 25% on average before the recession was over. So we're in a recession now. Second quarter GDP, of course, is going to be worse than first quarter, but things get back online. The recession may be short-lived, and it makes sense for markets to already be recovering before this recession's over. And I know, I think everybody's probably seen a lot of talking heads talk, about what they see in the markets, and in particular, Warren Buffett, I know, came out and was, saying that he doesn't think that the worst is over yet. But I saw something interesting today. If you look back on the financial crisis. So again, markets bottom on March 9th and they're already recovering. On June 24th, Warren Buffett came on CNBC and he said he doesn't see any green shoots in the economy. But at that time, the S&P was already 43% off the low. So the S&P had already recovered 43%. And Warren Buffett's on TV saying, I don't see any green shoots in the economy. There's no economic visibility. It's non-existent. And then 3 months after that, he spends $34 billion and buys Burlington Northern. So, I mean, you kind of have to take a lot of that with maybe not with a grain of salt, but I mean, just for some perspective, he was saying the same kind of things, and the same kind of things were being said, the last time we had come off of a market bottom. Something else we're looking at. So in March, we saw insider buying out, the ratio between insider buying and selling, that spiked just almost as high as what we saw in 2009. So that's positive. A few other reasons that we're looking at, just long-term tailwinds for the market. Of course, growing middle class in China and India, increasing global consumption, tech innovation, increasing productivity, strong consumer, corporates. We saw actually a record savings rate in March for consumers, up savings went up 13.1% in March, which is the highest since 1981. But again, 1981, Fed funds yield averaged over 16%. So now Americans have over 2.1 trillion in savings. Strong corporates, supply and demand. So there's, of course, when I talk about this, there's a demand for return in your 401k accounts for retiring, your pension liabilities, sovereign wealth funds. There's a certain demand for return, and with interest rates so low right now, that if you think about that kind of cutting supply, we think that markets will get more equity markets will attract more capital. We're not seeing any euphoric or rational exuberance in the market that typically comes when we see market bubbles. Very pessimistic recovery. Everybody's looking for everything to turn back down, which is good for us in our just that contrarian indicator. And then of course unprecedented stimulus. Something different about this stimulus is that it's actually you're seeing money supply spike up quite a bit. A lot of the stimulus that came during the financial crisis and afterwards, in my opinion, really never fully made it out to the market. You didn't see M2, M1 grow any faster than it had for the last 20 years. But here we're actually seeing, I think M1 was up close to 20% last month, and so I think we're going to get some reflation, maybe stagflation. I don't know, but I think if we get inflation, maybe even up towards 3%, above that, could be good for the equity markets. And so, what to do with all that? And I think, really sometimes the best thing in investing to do is nothing. And it's hard because markets are down, and when the VIX spikes up above 80, you feel about as helpless as a Shih Tzu puppy. And so you want to do something, but usually the best course of action is nothing. And it's actually more proactive, building a portfolio that fits your risk tolerance, that fits your time horizon, your objectives, what you're trying to do, something that you can stick with during bad times. And here are a few slides just to illustrate that bad investing behavior. So we have a 20-year period from 98 to 2018. And it doesn't include this latest crisis, but there's two pretty good crises in there. So stocks still returns 7.2%. The average investor only returns 3.4, so less than half. And, and that's all because of investors trying to time the market. We see money flow into the market when it's doing well, when it's already up, and then money pulling out, of course, when it's at the bottom. So investors typically behave very badly, and that really hasn't changed over time. I think timing the markets, it's kind of like switching lanes. Like if you're in a traffic jam, it's like you're in a lane that's stuck and you see the traffic on the left lane going faster. And so you work your way over there, and then that lane's stuck, and and then your previous lane starts moving in. So really hard to do. You have to be right. You have to be right twice. You have to be right getting out and then getting back in. And no one has really, no fund, no individual investor has been able to do that with any kind of consistency. So it typically diminishes returns over time. To help drive that point home a little more, just missing, okay, here we have this data on the left. We have market returns over that 20-year period. If you miss just the best 10 days in 20 years, your returns are cut basically in half to 3.7. Miss the best 20 days. Those are days, missing the best 20 days over the last 20 years, your returns are cut down to 1.5%, and then so on and so forth. Now, the problem is that the best days typically come right around the worst days. And you might say, by getting out of the market, I could miss the worst days too. So again, it's just extremely hard to do. And no one's been able to do it with any kind of consistency. So the best course of action is just to stay invested. For this is the last slide I've got, and then we'll take some questions. But this illustration is from American funds, but it's on Louis the loser. And the reason he's a loser is because Louis has $10,000 that he wants to invest every single year. And so from 97 to 2016, a 20-year period, he's investing $10,000. Well, we call him a loser because he tends to invest the $10,000 at the worst point of every year. So at the market top of every year is when he's investing money. But the reason he's smiling in this picture is because he still gets a 6.6% annualized return. And then he went back and did the math. He said, well, what if I had invested $10,000 per day on the best day at the market low for every single year? And his returns are better. They're 8.4% per year, but he still didn't do that bad. So he's happy. With that, just to recap, investing is hard. It's harder than it can be harder than putting toothpaste back in the tube, or and timing the markets makes that even harder. So we think that just controlling that investor behavior, or not trying to time the markets, is the most important thing that you can do. And yeah, while we're not exactly sure what the markets are going to do short term, we have some evidence to believe that they should continue to rebound. We know longer term that they'll recover, and that companies continue to make money. So again, controlling that investor behavior, and I think part of that is building an appropriate portfolio on the front end. And for us, that's if it's our stock portfolio, picking high quality names that we know can weather these kind of economic storms, and that give us the confidence to stick with through a crisis like this. So yeah, that's basically what I had. I've got some more data, just depending on where questions go, but yeah, I guess I'll stop sharing the screen now, and we can take some questions.
All right. Thank you, John. I appreciate the presentation. I thought I had a lot of good information, a lot of positive information that we're not necessarily seeing always in the news. So I'm glad to see that. But yeah, let's open up for questions. If you have a question, you can use the chat function. Just submit them to me, and I will go through them. And we'll try to get through as many as we can. So, okay, the first question we have is, since the market is at a low, would this be a good time to build an investment portfolio?
Yeah, I think, that depends, of course, on like your time horizon. What is this money for? But, in a vacuum, I would say yes. I would have said yes last year too, before the market turns out. I think, if you've got a 10-year time horizon, then yes, it's a good time to invest. Are the market's going to go down right after you invest? They might. They did the Louis the loser, but he's still got his 6.6% return. So I think now, if you have cash, what we've done for some clients is dollar cost average into the markets over several weeks, anywhere from 3 weeks to we'll put them on a 6-month dollar cost average plan. And by that I mean, you say you have, for round numbers, $100,000. You might invest $20,000 now, and then next week $20,000, or next month, to help average those prices out. Because if we get more volatility, it could help with that.
Okay. The next question we have is for, it says, for passive mutual fund investing with annual or semi-annual rebalancing, should you rebalance more often to take advantage of the swings in the market, or stick to the original schedule?
Yeah, I mean, the math, the math would say yes. So like if you did rebalance, where markets, typically what we do is, so we have our different asset classes in a balanced portfolio. We'll have our equities, bond allocation, whatever else, real estate. And we'll have those target weightings, and then we typically put bands around those target weightings. So it might be a 5-10% boundary. And so it's not necessarily we're going to rebalance once a year, every year, but if our allocation gets past one of those bands, then we rebalance back to target. So it depends. It depends on a lot of things, but I think in general, yeah, I would rebalancing once a year is good anyways, but being able to take advantage of market downturns, they're hard to do though. I mean, if you go back to March 23rd, I mean, you're probably going to be a little hesitant pushing that button to rebalance. I know, everybody was really, but yeah, I think, having that target allocation for each asset class, having boundaries around that, and then, rebalancing when that asset class falls outside those boundaries is the best approach.
The next question we have is, do you think we could see another big drop in a few months when earnings really start to show the effect of COVID-19? I don't believe we've really seen the financial impact yet. So what are your thoughts?
Yeah, I don't either. I think the worst is yet to come for sure. For earnings, for GDP, I think a lot of that's what's hard is how much of that is being priced in right now. I think a lot of it is, but again, like Jeremy Siegel said, most of the value, and he calculates over 90% of the value of the market is based on earnings a year out. So spring 2021 and beyond. And so I think while the worst news is yet to come, market's already looking a year out. So while that could happen, and again, I think, we could retest new lows. And I think we'll retest. I think we will retrace some. There will be some volatility, but right now, I don't think we're going to retest those lows that we saw in March 23rd, even though, the worst news is coming out. And again, like 2009, 2003, markets had already rebounded 25%, kind of like what they've done now. And we still didn't have the worst jobless claims, like Warren Buffett coming on CNBC. Market had already rebounded 40%, and then Warren Buffett comes on CNBC several months later, and he's like, I see no economic green shoots. He said, I just had cataract surgery earlier this year, but not so I can see well. I mean, he was making a joke, but he's like, I still can't see any green shoots in the economy. And yet the market had already rebounded 40%. And then 3 months later, he buys a whole company. So I think, yeah, we're going to get worse news, but I just think the market's going to, it may stay flat for a while. They call it like a square root recovery where it kind of goes up and then trades sideways for a while, but I just don't think we're going to retest the lows from here.
All right. We have two more questions that came in. The first one is, how do I help not make an emotional decision when it comes to my money?
Yeah, that's the hard part. Discipline in any kind of thing is hard. It's hard with, diets. It's hard with exercise. It's hard to stay disciplined, whatever it is, learning a new language. But with investing, it's no different. It's very emotional. Money is probably, a lot of people think it's the most emotionally tied thing. And so, and that's why that average investor does achieve a lower return than the overall market. I think there was a study done. There was a fund between 2000 and 2010. There was a mutual fund. The best performing mutual fund returned 18% per year, which is incredible because during that time period, the market was basically flat. The NASDAQ was down. So this fund returns 18% per year. They looked at flows going in and out of the fund to calculate average investor return. The average investor return in that fund was negative 11% per year. When the fund, if they just bought and if they just stayed in the fund, they would have made 18% per year. Now that's just how hard it is to say that. I think one thing that can help is having a financial advisor or an intermediary to help make those decisions and sound off. I think that's probably, Vanguard did a study that they had a study they called Advisor Alpha. And so they were saying, okay, what is a financial advisor? How do they, what's the alpha that they provide for a client? And by alpha, I mean, outperforming the market or outperforming, the average investor. And they said half of that alpha comes from just, helping clients stay disciplined. And so having an advisor can help. But I think really, if you don't have an advisor, it's just a matter of, really looking at the data, at long-term trends, just reminding yourself what this money's for, keeping that long-term mindset, it helps to not look at the accounts. There was a study done that Fidelity did. They looked at the top performing accounts across the board, and they actually found that the vast majority, a big number of the top performing accounts were dead people, where the account was just forgotten about. And so really just, stay invested. But yeah, I mean, that's the hardest part about it, is that discipline. But having an advisor can help. But if you don't have an advisor, I would say just not looking at it really. I mean, just doing your best to stay disciplined, talk to people about it and get a longer term perspective.
All right, so 2 more questions came in. They mentioned fiduciary standard on their website. I guess they're talking about the Hightower website. Is this their philosophy, or are they registered investment advisors too?
If they're talking about Hightower, like the firm I work for, yeah, we're a registered investment advisor, and we're legal fiduciaries for the client money that we manage. So our investment contract, binds us legally as a fiduciary for that money that we manage.
Okay. Yeah, I think that's what they were referring to. Yes, he says thank you. Okay, there we go. I guess the last question, unless anybody else has anything, go ahead and submit it. But we have, how much is the market being affected by foreign investors?
Yeah, I think a lot. I mean, I don't have any numbers on that, but I know, the U.S. markets attract a lot of foreign investment, and especially like I mean, it's more so, I would say, in currency. So like the dollar, of course, the world reserve currency. Every country still uses the dollar. Our markets, I think we do see a lot of inflows from foreign investors. We have the best markets in the world, the most efficient, the best regulatory body around them. So yeah, I think, I guess to answer the question, I think it does affect, but and I'd like to see the numbers. I don't have the numbers in front of me, but how much of investment is more domestic versus foreign? I do know that I have seen the numbers on, if you look at investor portfolios from different countries, there is that, what do they call it? The domain bias. So like, I think 80% of U.S. investors, or 80% of their investments are in U.S. markets, but that's kind of the same across the board. So like in China, like most of their investments are in Chinese companies, and Europe, same thing. So I do know that I think it's called the domain bias is prevalent across the world. But yeah, I don't have a great answer for that. But without looking at the numbers, I would think that foreign investment is pretty important.
Good deal. Okay, I guess we'll wrap it up with this last question, which is a fun question. What do you like most about working with families?
Really, I like just seeing them achieve what they want to do. So like, some of the, people are looking at retirement. What does that look like? Want to buy a beach house, be able to pay for college for grandkids or kids. And so seeing them accomplish that is probably the best part, and helping them do that and think about how to do that the best and the most tax efficient way, and get the most out of their investments. But yeah, seeing the clients and the families accomplish that. We work with a lot of multi-generation clients too. So we'll have, the great grandparents, mom and dad, and then the youngest. So it's fun to see that and meet all the different members of the family throughout, like, 4 levels of 4 generations, so.
That's very cool. All right. Well, thank you, John. I appreciate all of your advice today and you doing your presentation. I know a lot of other people have commented that they've appreciated your time and expertise as well. So thank you so much. And thank you
Yeah.
all for joining us and logging in during your lunch hour. We'll be sending the recording to everybody who registered as well as a survey. So definitely send your feedback. We'd love to hear your thoughts, and if there's any room for improvement, we'd love to hear that as well. Also, next Thursday, May 21st, we'll have our next Charger Chat with Senior Coordinator for the UAH Office of Career Services, Candace Phillips. So you can look for the registration link for that early next week. We'll be talking about career services during COVID-19. So thanks again, John, and I hope everybody has a great rest of their day, and go Chargers.
Thank you.
Thank you.